What's up, everybody? Good afternoon and welcome to our webinar on US stocks and the US market. It's so cool to have you here. Thanks for joining us. I am going to be co-hosting with my favorite co-ghost. I have to say that every time we hang out because I think it's really cool. The finance ghost, you might know him as the man behind Magic Markets podcast, which if you aren't subscribed to, you absolutely should. And Ghost Mail. So, hey, Ghost, what's happening?
Thank you, Carly. It's always good to hang out with you. And yeah, hopefully we can share some cool insights today and talk about what's been a bit of a tough market this year, I think, for everyone.
Listen, I'm not going to lie. I'm like avoiding logging into my Easy Equities USD account at the moment because a lot of the stocks I'm invested in are showing me flames. So yeah, we definitely need to talk about that.
You're not alone. I think that's true for most people this year.
It's been a roller coaster of emotion. Guys, everyone who's listening, our Easy Equities community, thanks so much for hanging out with us. As you know, we're talking about the world in your hands. And really what that means is having access to global stocks. We're talking about US stocks today, but remember, you've also got access to European markets, Australian markets, and the UK markets. You really do have the world in your hands, you know, in terms of your ability to invest in all these different things. So please keep looking out on our social media, keep checking our research portal. We're putting some really cool content on there for you guys, and have a go, take a chance, have a whirl at investing globally, be a global investor. So Ghost, let's talk about the US market, and specifically, I think the tech industry has, and I know so many of us are really invested in tech stocks. I've got Netflix, I've got Apple, you know, I've got all of those stocks. I've got Meta in my account, and you know, they've really taken a knock recently. And I don't know what is going on. Basically, what is happening?
So yeah, it has been quite the year, hasn't it? And it's been quite the year because last year was also quite the year in the other direction. So essentially what's happening here is the macroeconomic environment in which we all live and operate and invest has changed completely. And anyone who's been following, you know, if you ever see stories of the Fed hiking rates, for example, I mean, you would have seen inflation in the headlines, all these macroeconomic concepts. And unfortunately, we don't always realize what they mean for the stocks in our portfolios ultimately. So something I've always written and always tried to put forward to people is when you are investing in something, your success or failure is going to be a function of what you bought, but also how much you paid for it. We can never, ever pretend the valuation doesn't matter. It's always quite funny. Like when people buy a house, they focus very much on what they paid for it. But for some reason, when they buy stocks, they just go, oh, I just love Netflix. And it doesn't matter how much I pay for it because it's Netflix. But you would never do that with a house. You would never fall in love with a house at any cost because you know that's a bad financial decision. So stocks are exactly the same. It's like a car. It's exactly the same. And coming into this year, the valuations were just way, way too hot. I think the market peaked around about November last year. So they were off a bit already coming into this year. And it's been a long way down since then. And the problem is that valuation multiples, and that means stuff like price earnings ratio or EBITDA multiple or like price to sales that gets used sometimes in tech companies. These are just ways to value businesses with reference to their earnings were really, really high. And they were effectively pricing in, which means what is the market expecting when you're willing to pay that? Expectations of growth of like 20% or 30% forever, which is just impossible when you are a business the size of Apple. It doesn't matter how good you are, or, you know, or Netflix or Meta or Microsoft. You can't keep growing at that rate until the ends of time. So
indefinitely.
Exactly. And as money became more expensive this year, as interest rates have gone up, people have realized that actually, you know, those profits far in the future are not worth as much as they were a year ago, because now money is literally burning a hole in your pocket. So that's been one of the major issues. Valuations come down because the yield curve goes up. And another major issue has been the dollar. So these tech businesses are based in the US. Their expenses are typically in the US. They're hiring very expensive developers and tech people. And they are investing across the world, sure, but they are primarily cost-based in the US. They report in dollars. And they earn income from across the world and then translate it into dollars. So when the dollar is insanely strong, their international revenue is worth a lot less to them than it used to be, but they still have the big US expense base. So the strong dollar has really hurt the markets severely. And if the dollar starts to just normalize a bit, you'll definitely see the US equity market do well in that situation. So the frustration for us as South Africans is it always seems to work against us, the currency and the market. And that makes life a bit difficult. By the time the US dollar rand rate is a bit better for us, the US market might have already recovered, and then it's almost a bit too late to buy. So you almost need to create a pool of dollars or a pool of, whatever you're going to be investing in, because I know Easy Equities has got various countries and regions that you can now invest in. And then you play around with that pool of capital. You've got to kind of separate the currency decision from the assets you want to actually invest in. So I know I've covered quite a bit there. I'll stop there and let you jump in. But yeah, there's been a lot going on this year.
That's interesting to consider all those factors. Would you say now that companies are pricing more at sort of a realistic value? Is this an opportunity for people to maybe invest if they do have, a belief in the long-term potential of a specific stock or a specific industry? Is this an opportunity for them then to come in at a lower price?
So the answer is it depends, which I know is the worst. It depends on the company. So some of them have definitely come down to levels that are looking a little bit more reasonable. Some of them, in my opinion, are still looking somewhat overpriced. I think, the old advice of if you're investing for the very long term and you're kind of dripping cash in every month is still generally sound advice. I think you've got to be careful if you have a lot of personal debt right now, because obviously interest rates are going up and will continue to go up. We'll never give the blanket suggestion of, hey, just put everything in the market. But, that old story of just being consistent still applies over the next 20, 30 years. If you're looking at it, if you're a more active kind of investor, and I'm going to use the swear word for Easy Equities, which is trader, then if you're more active, we need a word in the middle, because it's possible to be someone who takes a view for like 3 or 4 months and tries to play a range. And that's actually been a very good strategy this year for what it's worth. Then there's lots of, then there's lots of opportunities that you can play around with. But yes, things are definitely looking more palatable now than, a year ago. I must be honest, at the end of 2021, the valuations were completely insane.
Yeah. And I think that also speaks to another sort of, long-standing principle, and that is diversification, right? So I know, myself included, I'm quite heavily weighted in tech stocks in my US account. And, I think it's important to make sure that you are diversified and you are potentially looking at other industries. I mean, do you think that there are other places where people could look, other industries? Do you think it's good to have something to counteract some of the knock that the tech sector's had?
Yeah, absolutely. So diversification is still firmly your friend, and diversification doesn't mean, hey, I have a portfolio of 20 tech stocks. That's not diversified, right? You're diversified in terms of the companies you're choosing. But if the whole sector unwinds, then that diversification is not going to help you at all. So absolutely, people have kind of forgotten in the past couple of years, the NASDAQ is not the be all and end all of global stocks. Global stocks doesn't mean only the fan stocks. We need a new acronym for that, because about half of them have now changed their name. What it means is building a proper international portfolio. You've got literally the world's best companies to choose from in the US market, quite literally. And you certainly you don't even need to own any tech stocks if you don't want to, although I think long term, it's a good idea to have that exposure. But there are loads of brilliant industrials businesses. I mean, there are some cracking companies. We covered one on Magic Markets Premium recently called Cisco, which is like effectively their Bidcorp. It's the food service business that supplies the restaurants in the US. They supply more than half the restaurants in the United States with what they need basically to run as a restaurant. I mean, that is a phenomenal business. It's got nothing to do with tech whatsoever, and there are many other examples of those. So I would encourage people, don't just think, hey, my international portfolio should be tech. It's not the case. You should have some tech, but you need to look beyond that and think about what other exposures are useful to you, going forward. And certainly tech has been a horrible underperformer this year. It's not where you want it to be.
I feel like tech is the celebrity. It always gets the red carpet snaps, but there's a lot of other companies that are doing cool things that are behind the scenes that we don't necessarily know about, like the one you just mentioned. I mean, yeah, exactly. That's good to know.
100%. There's a lot of stocks out there, lots and lots.
Well, let's start with a couple of interesting tech stocks. Let's look at Apple, for example. Now, Apple's just released their iPhone 14. Sales aren't what people expected them to be, even though they've had a record quarter. What do you have to say about Apple, its growth trend? Can it support its valuation? Why is the price down 20%?
Yeah, 20% this year. So some of it is the macroeconomic issues. I mean, Apple, in terms of their underlying performance, is actually doing quite well compared to some of the other tech stocks. So I'm personally a bit cheaper in these things. I happily have a Xiaomi next to me, actually, that I recently got, and it's on Android because it works. I feel like I'm getting old. I'm getting to that point where I'm like, I just want a cell phone as opposed to a really cool toy. And I feel like I'm sounding like my dad now, which is unacceptable. But moving on from that,
I just want the Instagram filters, I just want like
well,
the great filters.
Yeah, there we go.
I'm that person.
but then you get Mrs. Ghost, who is completely obsessed with Apple and will not even contemplate not having Apple. She's a school teacher, and Apple is so entrenched in the way these schools operate. So it's an insanely special and very, very powerful business. We know that. They've just released a record quarter's results. They have an all-time high now for the number of installed Apple devices. Now, why that's important is because their services business has the highest margin in the group by a long shot. It makes about 20% of revenue, but it contributes about a third of gross margin to Apple. So what they want is they just want a lot of Apple devices out there, buying apps, making payments through the App Store, et cetera, et cetera. They own an entire ecosystem, which is exactly what Mark Zuckerberg is dreaming of building now with the metaverse. And a really impressive part of Apple's story this year is they managed to expand their gross profit margin despite all these supply chain nightmares. And for the full year, their product margin went up to 36.2%. It was just over 35 last year. That's super impressive in the environment that we find ourselves in this year. And obviously, because of the services business, it just takes the group gross margin way higher than that. So they've done a good job here of bucking the trend in big tech. Their operating margins are higher. Most of the tech companies' margins are actually under pressure. As you say, iPhone sales causing a little bit of concern, and there were some questions from analysts about that. Of course, Tim Cook and the team tried to deflect, and might I say, I hope he's more excited about the new iPhone than he was about waving the checkered flag at the Formula One last week, because that was one of the saddest things I've ever seen in my life. Moving on from that, Mac had its best ever quarter, yet the iPad is down. And a lot of it comes down to new product launch times. They don't always launch a new product in this quarter, and there's an exact launch to compare to in the same quarter last year. So there's always going to be these funnies quarter on quarter, and supply chains are causing some pain. They all US execs are like this. All execs are like this. If someone asks a question on something difficult, like, how's it going with the iPhones? They will have a few things in their pocket that they pull out as being good news stories. So wearables, for example, like an Apple Watch. He points out that 2/3 of those watches were sold to customers who haven't previously owned a watch. And then everyone goes, oh, yeah, that sounds good. Now he's getting new customers, which he is. But I can assure you the iPhone is a lot more important than the Apple Watch. So the thing to watch with Apple is they've had a good year overall versus last year. But there's a concept called cadence. And cadence means not versus last year. It means how have you been doing over the past 2, 3, 4, 5 quarters? It's like if you run your own business, you will never sit here, or you probably won't sit here and go, well, this November I made X, and I feel really good about that because last November I made a lot less than that. No, you're going to sit and go, what did I make last month? And what did I make the month before that? Is my business actually growing or is it shrinking? And that is cadence. And what we're seeing in Apple is their fourth quarter performance was a little bit slow, to say the least. Their earnings per share was only up 4%. Now, that is not exciting. You can go and buy a hell of a lot of very boring companies on the JSE that are growing faster than that and trading at a much lower valuation multiple than dear old Apple. So I have my doubts about whether or not it's going to give exciting returns over the next year. It's been quite resilient this year, but now it looks expensive compared to where the earnings growth is. And it could still, it could still disappoint. It's been one of the better tech companies, and I'm not sure that is sustainable.
So I'm always surprised, whenever there's like a recession or talk of a recession, it's always interesting to see that luxury goods and kind of these expensive things you don't expect people to buy, they actually go and they do buy. They want to treat themselves. They want to feel good. Maybe Apple could be one of those stories where despite this recession, people want nice stuff, so maybe we'll see some uptick there.
I think Apple's challenge is that there are very real substitutes. So as much as everyone loves an iPhone, it
True.
is pretty true that the Android phone doesn't do everything the iPhone does, but heck, it's not far off. You compare it to a company like Ferrari, which you can also buy on your Easy Equities app. The ticker is Race, personal favorite of mine. And that is a luxury goods company of note because there are not a lot of substitutes. Ferrari is what it is, and it's been that way for a very long time, and it's incredible the way that business actually works, the way they manage supply and demand. For me, luxury goods companies are always measured by whether or not they constrain their supply on purpose. Ferrari makes far fewer cars every year than they could actually sell. And they do this to keep the prices very, very high and maximize the margin on each car and keep it nice and exclusive. Some 100%. Of the leading jewelry manufacturers are the same. So I think, I wonder if Apple isn't just at that point where it's aspirational rather than luxury. And when things get ugly, people trade down and then they go and buy an Android phone, or they just don't replace their phone. I don't know if you've also experienced this, but phones are lasting longer than they used to. I previously, maybe I'm just very cheap with phones, but my previous Huawei did like 5 years.
That's good going. I thought so too. The battery still going? That's amazing.
No, well, it wasn't. So that's why I had to switch. But anyway, you take my point though. You don't have to change your phone every 2 years.
Yeah. Well, you spoke about sort of looking at more than just phones with Apple, and there's like this whole universe of products. And you also mentioned Zuckerberg. So let's talk about Meta and the metaverse and what's going on with that stock. Everyone's talking about the risks at Meta. It is all about this metaverse. So is it facing risks? What is Meta up to at the moment?
So Zuck rhymes with another word that lends itself to many puns that I won't use on this webinar. And it's a word many have used this year when opening their portfolio and looking at their Meta stocks. It's down 73% this year, which is hideous. And it's because Mark Zuckerberg is a mad scientist. That is the truth of it. He has decided that no matter what the market says or thinks, he is going to push as hard as possible on building out what he believes the future of the company is. So it makes it incredibly risky because one of two things is going to happen. Either he's going to drive it so far down that they actually basically kick him out and put in someone a bit more sensible. And I would remind everyone that Sheryl Sandberg is no longer involved in the business. And she was a very good counterbalance to his kind of madness. There isn't really anyone doing that. So either it gets so ugly, and it's going to be difficult because Zuckerberg is, from memory, I think he basically controls the company. He's got super voting shares. So I'm not practically sure how they would do that. So that means he's going to just keep pushing and pushing and pushing for as long as he can get away with it. I think next year, Meta is going to make basically no free cash flow. And free cash flow, for those who don't know, that basically means, a company will make cash profits and then it either returns those to shareholders, in which case there was free cash flow, or it needs to go and reinvest in the company, CapEx, build out international expansion or technology or whatever. What is normal is a company will make, $100 in profits. They will spend like $30 in CapEx, and the rest will be available as free cash flow for shareholders to get a piece of. Not Zuckerberg. That is not how this man rolls. He's got over $41 billion in cash on the balance sheet, and I can assure you he's going to try and use as much of it as he can in building this thing out. And the problem is that it's not just the metaverse that is so risky. The core business is also facing some tough times. Everyone always jokes that no one's on Facebook anymore. Who uses Facebook? Only my mother uses Facebook. Well, the stats tell us that your mother uses Facebook, and so do you, to find out what your mom's doing, even if you're not willing to admit it.
That
is what the stats are telling us. What we can see, and I think all of us have probably experienced this, is that the users of Facebook are posting less than they used to. And we are being served more and more content by third-party content creators. And everyone thinks, oh, that's a disaster. Facebook's going to die. Well, I would remind you that that's how YouTube works. And YouTube makes an absolute fortune. YouTube's ad revenue in a given quarter is almost the size of Netflix's revenue in any given quarter. And YouTube is only just part of Google. It's not a separate company. So, it's not the worst strategy to do this creator type content. The challenge is they've had to respond to TikTok, and TikTok is all about short form videos. Yeah. And so Facebook has introduced Reels, and it's becoming harder and harder, or not harder and harder. It's going to get a little bit easier, but it's been very difficult to monetize Reels. So what they are saying in their earnings is the number of ads that they are serving has actually gone up, but the amount they make per ad has come off quite sharply. And that's partially because of what we're seeing with a macroeconomic slowdown and pressure on advertising revenue. But it's also because they just can't charge as much for reels as they can charge for stories or as they can charge for news feed, etc. So there's a lot of risk right now at Meta, and we just don't know which way it's going to go.
What is the business that they've invested quite a bit into or are going to? It's Reality Labs. Is that what it's called?
Yeah, it's called Reality Labs. And
what is that?
So Reality Labs is essentially his metaverse dream. And he says there are 4 pillars to it. So one is the sort of social metaverse where you would have an avatar. And then if you're on Twitter, you would have seen those utterly absurd videos where it looks like the graphics from one of the early Sims games. And then everyone rips Zuckerberg off and they're like, how can you be spending money on this? And they're right. So it's a bit weird what's going on there. And they don't do themselves any favors. A few weeks ago, they were very excited because now people can have moving legs, and they made a whole thing out of legs. And people are like, are you joking? You are spending all our money on this. What is happening? So that's not great. The piece that is monetizable in the near term, and I think if this goes badly for him, it might bring to a stop some of the madness, but honestly, who knows, is the virtual reality headsets, but in almost a work context. So, and this is why the metaverse may not be the stupidest thing ever. I hold Meta shares, much to my sadness right now, but I'm not selling them either. So imagine a situation where everyone on this call isn't on a PC or a laptop or a phone, but instead you are wearing something which hopefully doesn't look as ridiculous as they currently do. And you feel like you're sitting at the table with us. I have my little ghost avatar. Everyone has their own little avatar that they've created. And you're sitting around a table. You almost feel like you can reach out and shake someone's hand or touch someone or smile or all the things we would normally do in a social setting, right? That's what this thing could technically become. And you can imagine a world where there's lots of applications for why that's cool. Let's say I want to watch a sports game. Now I can be there as opposed to watching it on DSTV.
That would be pretty amazing.
There are some applications, right, that are not like completely insane, but this is very sci-fi stuff. And the other pillars are augmented reality. And then the fourth one, which is extremely sci-fi, is creating, he says, discrete ways to communicate with the device. So that's like neural. I'm not even going to go there. I don't think anyone knows how that's going to work. That basically means you just think it and the device does something. That's a long way from where we are today, where they are celebrating people's legs being able to move. So,
yeah, sure.
And this is the thing, is no one quite understands how this is going to monetize. For now, he's selling, I keep saying he, because it really is Zuckerberg. You just get the feeling that no one else is involved here right now in an executive level. They're just bums on seats, as opposed to him making all the decisions. And, my worry, one of my multiple worries, is that the revenue in Reality Labs actually went down this quarter versus the last one. So they're selling less quarter on quarter. And that's not what you want to see when they are spending this kind of money. It should be flying, right? You should have people trying out these headsets all over the place. If they can't even get that right at this early stage, then you've got to ask some very big questions about this.
Yeah. Okay, so that's our friends at Facebook. One of the shares I've got in my portfolio that has been such a favorite of mine for a very long time, but this year has disappointed me. It's down 54%. Is Netflix. Is there anything new happening in Netflix? Is it just business as usual? It seems like there's a bit of renewed energy around it, but has anything changed?
So Netflix is super interesting because I started this business in Feb 2020, and Netflix was one of the first companies I wrote on. And, because I'm a CA by training and profession, I kind of dig deep into the numbers. It's not the story that gets me too excited. You got to go and really have a look. And what struck me about Netflix is just the amount they were spending on content in order to drive the subscription growth. And the problem with content, as we all know, it's fresh today and it's gone tomorrow. Yes, some of the content genuinely has or has incredible longevity. People will go back now and watch. I know this because Mrs. Ghost just binged Desperate Housewives from start to finish, although I think that was actually on Disney Plus, which brings me to another point: competition. So not only is Netflix facing competition, but there are really only a handful of shows that stand the test of time. Most of the stuff doesn't. So I've always had an issue with how long Netflix takes to write down the value of its content. So what happens is they will create a movie, they will spend a fortune on it, and they will recognize that as capital expenditure. They won't tell you this is an expense, that it hits its profits. Over time, they will write down the value of that movie, and they will say, okay, in the first year, it loses a lot of value, then some, then some, then some, almost like a car. So they're saying a movie that's 5 or 6 years old still has value. Now that's quite debatable, I think, personally. Now, if you look at how much they're spending on content, if they expensed everything, Netflix's financials would look hideous. So you have to believe that the content actually does have longevity, is the first issue. Then you have to believe that Netflix is going to find better ways to monetize their user base. And they are trying a few things to do this. So they've just introduced an advertising supported tier in 12 markets. And what that means, it's cheaper. So it's $20 a month for Netflix Premium in the US. It's $7 a month for the ad supported tier. So for some people, they're very happy, or not some, a lot of people are very happy to save $13 a month and suffer through adverts, if that helps them afford Netflix and, say, Disney Plus. But interestingly enough, Netflix reckons this is a defensive move. They're not actually going to make more revenue because some people are going to trade down now, and Netflix will then recoup some of that from advertisers. But they don't think this is much of a money spinner for them. It's actually Microsoft running around selling the ads, believe it or not. And Microsoft will make money from this, but Netflix won't really. The other thing they're trying to do is crack down on password sharing. I saw on Twitter, someone found an old tweet from them, I think in like 2017. It said, love is sharing your Netflix password. Love is now no longer sharing your Netflix password. And it's not going to be so easy to change that behavior when you spend years encouraging people to share their Netflix passwords. That is not going to be so easy. The one other thing in Netflix that I've got to just mention is I've never understood why they feel the need to go and make a movie with Leonardo DiCaprio for a captive audience. These people are superstars and they charge an astronomical amount of money. Can you imagine making Top Gun Maverick and then releasing it only on Netflix? How could you ever make money from that? So the problem is they try and make blockbusters and then they ignore the cinemas. They don't go to the box office. And that is starting to change. And you can kind of see through the rubbish. So on the earnings transcript, Reed Hastings, and he's the co-founder of Netflix. He said basically, the movies are going to box office so they can qualify for awards. Yes, sure. But actually, I think they are doing it so they can see what happens with the economics, because Netflix's business would look a lot better if their movies went to the box office for 2 weeks or 3 weeks and then went on to Netflix, because then suddenly the amount they make off the content is very different to how it is today. So fascinating business.
If you see a great movie and then it's suddenly on Netflix, I think that would drive interest into signups. So 100%. We could teach them a thing or two, Ghost. They should just give us the reins.
I tell you, it's fascinating to see how everyone wants to be a studio and the distribution, and it doesn't work. It's impossible for all of them to make money. They cannot. So they're all going to fight to the death now. And it was quite funny as well in the Netflix earnings. They made a comment, all of our competitors currently are losing money. I thought to myself, have you guys forgotten what the first 7 years of your life looked like? You were also losing tons and tons of money. Like, just because you're now at the point where you're kind of okay, it doesn't mean that others are not going to get there. Anyway.
Exactly. I'd feel very on my toes if I was Netflix, because there are a lot of competitors and they are putting up some really cool stuff.
Exactly.
So I actually invested in my US account today, and because I read this awesome note about Netflix this week, not Netflix, Microsoft this week. Microsoft is what I bought because I've been hanging on. I've had this cash that I've wanted to invest in US stocks, and I've just been nervous about where to put it. Like I said, my tech stocks are not doing well. I don't really have another favorite in mind, and I've just been waiting for the right thing at the right time. And when I read your note that you did for our research portal, if anyone wants to go and read it on Microsoft, I thought this looks like a good buy to me. Why are you such a fan of Microsoft?
So, Microsoft is my sort of pick of the litter, and it's because they touch everything and they make a lot of subscription revenue along the way. So for example, their cloud business is super, super good. Everyone uses Office. Everyone uses Windows. It's just how it is. And it's not going to go away. It's not a Facebook situation of like, oh, I don't feel like using Facebook today. You can't wake up in the morning and go, you know what, I just don't feel like using Excel. I'm going to let my boss know that today is not an Excel day for me.
I feel like that every day, if only that was the case.
It's just not going to happen. Like, Google Workspace is a very poor substitute in my eyes. It works for startups, but really in any kind of corporate environment or people who need like stronger productivity tools, it's Office. And that's just how it is. So, and that's just one part of Microsoft's business. They really do have a strong business. So their cloud business is still growing really, really strongly. In constant currency, it grew in the latest quarter by 31%. Microsoft is the one that is still doing those sort of growth rates. Admittedly, not across the business, but in parts of it. Here's another fun fact that you are not going to want to know as a Zoom shareholder, and it's quite funny because we're on a Zoom right now. But Zoom's business has come under a lot of pressure from Microsoft Teams, because if you have Office, you've got Teams, and that means you don't necessarily need Zoom, right? Zoom is very good on certain things like events, like this, etc. But for a lot of people, Teams kind of just replaced it. And there's an amazing stat that the average commercial user now spends more time in Teams chat than in email, which I found quite extraordinary. So that was very interesting. And Teams Phone, for example, is doing really well, which is not good news for Zoom. So it's just interesting to see that coming through. LinkedIn is part of Microsoft. I find LinkedIn exceptionally irritating, but it is a really, really good social media platform. It is full of people telling each other every day how super smart they are, and people want to read it so other people will read theirs, and it's all wonderful. And the point is, revenue is up 17% in this quarter. Now, in the other social media networks, I mean, Meta eked out what, like 4%? And that's only in constant currency. This is the real deal. This is 17% as reported. So that is incredibly, incredibly strong. YouTube revenue was also down. I know we haven't spoken about Alphabet, and I don't think we'll have time, but YouTube revenue was down sort of in the last 2 quarters. So LinkedIn's really doing nicely. As I mentioned, Microsoft is now selling adverts for Netflix. So, I mean, you don't even think about that with Microsoft. Why are they selling ads? But think about it. When you use the start button in Windows, you probably get served a little advert. If you make a terrible mistake and instead of opening Google like a normal person, you open Bing to search because you opened Edge by accident, which is useless because it has no idea where you are in the world. I'll never understand Bing. But anyway, they sell ads in Bing as well, which is a Microsoft product. So the Microsoft advertising team, the sales team, has plugged straight into Netflix and is now selling that whole ad-supported tier. And guess what? Microsoft doesn't carry the cost of the content. So I don't know what the commercial arrangement is. I don't think it's been made public. But let's say they take 20% of every ad they sell on Netflix. Thanks for coming. That's it. They don't have the costs of content. They don't need to get you the stuff to your room. It's done.
And as you said, that's going to be part of Netflix's future model, so.
Very much so. The gaming side of Microsoft is interesting. So that's Xbox. Hardware sales are doing really well, actually, but the content is doing quite poorly. Services revenue was down. And now you'll know that Microsoft is in the process of trying to buy Activision Blizzard. Huge deal going through the Competition Commission in various countries because Microsoft wants to get its hands on that content. So again, when you invest in something like Microsoft, you're investing in a management team who are going to go out there and do the hard work for you. They're going to look at their business and say, well, what gap do I need to plug? Okay, my gaming titles aren't what they should be. Let me just casually go and try and buy Activision Blizzard. It's like Elon Musk at scale, except they're sensible instead of crazy. That's really what you are investing in here. It's not all roses and... Yeah.
It sounds like the management team in general is making some reasonable decisions, They're, I would want to say being conservative, but they're not, pulling a Zuckerberg and piling loads of cash into these kind of high-risk projects.
No, you're dealing with a corporate board here, whereas in Meta, you're dealing with the person who founded the business. You're not dealing with Bill Gates anymore in Microsoft. He's running around doing philanthropy and getting himself into trouble and doing all kinds of things. It's a professional board now. It's just like Apple. These are very, very mature businesses. They're still tech companies, but they are not attached to a symbolic founder anymore, which is important. And look, Microsoft is facing some challenges. Free cash flow is down year on year. Earnings are down year on year. They are not immune from the challenges that are facing the tech market. But what I just love about Microsoft is that long term, like if you forced me right now, I can pick one stock to buy for Toddler Ghost and only one. I can guarantee it would be Microsoft every time.
Okay, that's a strong stance. I like it. I'm glad I just bought.
Well, let's hope it works out. Failing which, it's one of those situations where if the market keeps going down, you leave some in the kitty, and when it's down 10 or 15%, you go, okay, let me add a little bit more, and you average your in price down. And when you look back in 10 years, you go, okay, that worked, hopefully, touch wood.
So we've spoken about some pretty big names today, but I want to throw in a wild card. Is there anything sort of like tech, left field, that's on your radar?
So there is, and it's a company that you would never think of if you think about tech, and that is Accenture. So that's the management consulting firm. Now everyone's sitting going, that's not technology, that's people. But Accenture, unlike McKinsey or Bain, for example, they do tech-led and tech-focused consulting. Now, what that means in English is they will go into an enormous corporate and they will help that corporate design the cloud strategy and then implement it. And Accenture might choose Azure, which is Microsoft. They might choose Amazon Web Services. They might choose Google Cloud. But either way, they have the power to basically go in and say to that company, we are independent advisors to you. Let us help you design your cloud strategy. Let us help you design your ERP systems. Let us help you understand what the metaverse is and what it actually looks like. And they do lots and lots of other stuff too. And the power of Accenture's model is once they are in your business, you just can't get rid of them because you need them. They've now built everything. And if you fire all these consultants, they pack up and go to the next client. And you now sit there as the company going, right, what do we do with this now? We don't have the full-time resources who understand what's been built here. So it becomes this incredible, we covered it on Magic Markets Premium and we joked, it's like Hotel California. As Accenture consultants can check out, but they can never leave because once they're in your business, they are in your business. And what is quite remarkable is they ultimately sell time, which everyone thinks is the least sexy business model in the whole world. Why would you make money selling time? But the reality is if you can sell the time for a lot more than you are paying someone for that time, you have a great business. And what's happening is Accenture is managing to grow its margins because they are charging more and more and more for such advanced work, and they are finding ways to deliver it more efficiently. So unfortunately, Accenture's valuation is high. It's a stock that I've owned for a while. It's a stock I'll own also probably forever. But it's a very, very clever way to play the broader tech infrastructure without choosing a Meta or an Apple or a Microsoft. It's the shovel in the gold rush, quite literally.
Yeah, I would imagine as well with, the last couple of years and how that's accelerated digital transformation, that there are a lot of businesses that really need that kind of assistance. You need to kind of fast track your innovation very quickly to meet the demands of today's world. So I can see the demand for that kind of business.
100%. There's a huge tailwind to the story, cloud computing. The pandemic accelerated all of this, and it's not going to go away. It really isn't.
Well, Ghost, that's us. Our time is up. We've actually run a bit over, but I just enjoy chatting to you so much. I could just grab a drink and we could carry on all night, but I'm sure everyone else has other things to do. So we are going to wrap it up there. Thank you, everyone, for joining us. We are going to load this webinar on YouTube. So if you want to go back and listen to our banter all over again, you can do that. You can share it. Please check out the Easy Equities research portal. We are loading some very cool notes on there on some US stocks, other international stocks that could maybe help inform some of your buying or selling decisions. So do check that out. Ghost, it's been a treat. It always is.
Thank you. And I would just remind the attendees, anyone watching this, there is the ability to get a discount on Magic Markets Premium if you are an Easy Equities user. So maybe when we post this, we can just put some of those details in. And yeah, I would invite you to come and get some proper research on global stocks and come and learn together. That's what it's all about.
And we're actually going to be giving away 5 subscriptions to Magic Markets every single week for the next 4 weeks for someone who funds their international account for the first time. So we want to give you guys a kickstart for your global investing endeavors. And I've just spent this afternoon listening to the latest Magic Markets. It's a really cool platform, very cool information. So they're up for grabs. Go and get them. Thanks, everybody. Have a superb afternoon. Good luck with the markets.
Ciao.